Alright, so picking up where we left off here, after we have recorded all the transactions in the journal, the next step, step 4, is to post them to the ledger. And so there's really two ways we kind of do this in accounting. So each account, so cash, accounts payable, land, capital, each account has its own ledger. And in that ledger, we can see all of the credits and debits that took place for this account, and it also keeps a running total of the balance. So, for instance, if I want to know how much cash I have or how much I owe on my loan, I can go to the ledger and it will show me all of the money that came in and all of the money that went out and what the current balance in that account is. So in the real world, we use what's called a 4-column ledger. And so you have some homework problems where we're doing that. I'm going to show you that one. But in accounting class, we often just use that T account that we did a little earlier in this chapter to show the same thing, because it'll have the account name, and each account will have its own T account, and we put all the debits on this side and all the credits on this side, and then we can add them all up and get the balance in the account. So the T account is just a simplified representation of the 4-column ledger, but it does the same thing, and it's how we can see in one place. So for instance, again, this is why you have both the journal and the ledger. If I want to see what's going on in a particular account, like how much cash I have, I can go to the T account or the ledger for cash, and I can see a summary of all the transactions that I've done that affected cash, and I can also find the balance in cash. But if I look at one of those and I see, what's this check for $10,000, I can reference, and that's the cross-reference. I can find out where to go find that in the journal and see what that check was actually written for. So this is how it looks like. So here's our journal here, right? And I have a credit and a debit, and so the debit was to cash, and so cash has its own T account or its ledger account, and I put this on the debit side. And then the credit was to capital, so capital has its own ledger account, and I put this on the credit side since I credited that account. And then the date over here on the outside is kind of the little reference, so that if I wanted to see where this money came from, that tells me I can go look at the journal, find November 1st, and find that transaction to see what that was for. Now, here's our T account up here, and then this is the 4-column journal. So the way the 4-column journal works, we've got the date. This tells you where it came from. So a J1 means this came from page 1 of the journal. J2 means this transaction is recorded on page 2 of the journal. So that's that kind of cross-referencing system. And then here is the transaction. And so each transaction is either a debit or a credit. It has to be one or the other. So here's November 1st. That was a debit. So this is the debit side, and this is the credit side. So here I put that debit in. November 2nd, this was on the credit side. So I put on the credit. November 8th was on the debit, so that's over here. 3,200 on the credit side, etc. And so each of these transactions, if it was a debit, I put it in the debit column. If it was a credit, I put it in the credit column. That's the transaction itself. Now this keeps a running total of the balance. So after each transaction, I recalculate the new balance. I started with 0, because this was the first transaction, and I debited, so I had a debit balance of $30,000. My next transaction was a credit, which means that subtracts from the balance, that decreases the balance, but the balance is still a debit. So the $30,000 I had minus the $20,000 means my new balance is $10,000. So if it's on the debit side for an asset, I'm going to add to the previous balance. If it's on the credit side, I'm going to subtract from the previous balance. So I had $10,000, this is a debit, so I added $5,500, here's my new balance. Then this is a credit, so I subtracted $3,200, here's my new balance. Subtracted, and then here I added. And so the balance is, again, this is whatever the normal balance in the account is. So I can debit and credit, but the balance, because this is an asset, will always be on the debit side. So it's going to go up and down, but it's always going to be on the debit side. That's, some people get mixed up. They see this and then they suddenly try to move the balance over here. But we shouldn't ever see a credit balance on an asset account. In this case, if it was cash and we had a credit balance, that means we're negative. So I guess we could have that if our account was overdrawn, our checking account. But for the most, we should always be on the debt. If this was a liability, the balance should always be on the credit side. And so after we post it, then we have to go back to the journal and tell it that we posted it. So this is kind of showing you how. So here's the journal part, and then here's the ledger for cash, and here's the ledger for the capital account. And so I took this 30,000 debit and I put it in the debit column, and so there's my new balance. I took this 30,000 credit and I put that in the credit column of the capital account, and my new balance over here is on the credit side of 31,000. This again tells me where it came from, but then once I've posted it, I go back to the journal and I say, okay, this $30,000 debit to cash, I posted that to account 101. So that's what goes in here. This 30,000 credit to capital, I posted that to account 301, so I put that here. And so this is my cross-referencing system. When I'm looking at the ledger, I can tell where it came from. When I'm looking at the journal, I can tell where I posted it to. And then I'm done. That's the whole thing. So the T account, this is a summary of accounts payable. And so again, this is, any of these problems I do are in those demo problems. So I had a bunch of transactions, both debits and credits. Accounts payable is a liability, and a liability should have a credit balance, right? So these are adding to the balance, and these are subtracting from the balance. So adding, subtracting. So if I add up the total credits to this account, I get $22,500 total credits. If I add up these two debits, I get 18,000 total debits. So the balance in the account, I take the total, and the credits are bigger, so I take the credits minus the debits, and I come up with 4,500 as my balance. So this is total credits of 22,500 minus total debits of 18,000 gives me 4,500. If the debit side was bigger than the credit side, the balance would go over to that side. But I better not ever see that for a liability. So you can, put it on whichever side is bigger, put the difference on whichever side is bigger, but then check yourself. This is a liability, so the normal balance is a credit. So I better end up on the credit side. All right, here's a problem in the demo problems where we're going to kind of do all three, all 5 steps. So we journalize the transaction first, and then we're going to post them to the T accounts. So first we're going to say, all right, let's look at the March 15th, purchased office supplies on account. Which 2 accounts are affected? Office supplies is one. That's an asset, and I purchased the supplies, so that's going up. If an asset is increasing, that means that should be my debit. I didn't pay for them yet, though. I bought them on account, so that's accounts payable. That's a liability. The amount I owe is going up, so that liability is going up, and to increase a liability is a credit. So I've analyzed the transactions. That's the first 2 steps, and then determine the credits or the debits. And so I will record that transaction on March 15th. I debited office supplies, so I write the debit first. I debit office supplies for $2,600, and then I credit accounts payable. So I indent that. Here's my debit column, here's my credit column, and I credit $2,600. So that takes care of the first one. The second one, I paid $1,300 in account. As soon as I see paid, I know that there's cash and it's going down. Cash is an asset, so if it's going down, that's going to be my credit. And what did I pay it on? I paid it on that money that I owed. I paid it on my accounts payable. So the amount that I owe, the balance in accounts payable, is going down. And so to decrease a liability, I'm going to debit that. So now I know my debit and my credit. So March 28th, I'm going to debit accounts payable for $1,300, and I'm going to credit cash for $1,300. So that takes care of part one. Then part two says to post each of these to the T account. So this would be the same thing as posting it to the ledger, but a simplified version. So we need to open 3 T accounts. They tell us that cash has a beginning balance of $2,300. We know that cash is an asset and the normal balance is a debit, so that $23,000, I think I said 100, $23,000 must be on the debit side. So I'm going to put that over here and tell it that's my balance. And then I'm going to open a T account for office supplies. They don't say anything about a beginning balance, so I'll leave that there. And then I'm going to open a T account for accounts payable. So now I'm going to post these transactions that I just did to the ledgers. So the first one, I put a debit to office supplies. So I'm going to put this over here, 2,600, then you kind of put the date out here, 3/15. So that takes care of that one. And then I need to take care of the credit. So I credited accounts payable. So I'll go over here and put that 2,600, and there's the date. So that takes care of the first one. The second transaction on the 28th, I debited accounts payable. So I'm going to put that debit right here on the debit side of accounts payable, and that's on 3/28. And then I credited cash. So I'll put that over here on 3/28, and that takes care of the second half. So now I've posted those. The last thing it wants me to do is calculate the balance in each account. So cash, I started with $23,000, and then I credited it $1,300. So a credit is a decrease to cash. So the $23,000 I started with minus the $1,300 gives me a new balance in this account of $21,700. Office supplies, I started with 0, I added 2,600, so the balance is just the 2,600. And then accounts payable, I added 2,600 to what I owe, but then I subtracted what I paid of 1,300, so the balance will go over here on this side. So that's the 26 minus the 13 I paid, showing that I still owe 1,300. And accounts payable has a normal balance of a credit, so that's right that this is on the credit side and my cash is on the debit side, because that makes sense with the normal balance in those accounts. So this kind of shows you what it looks like then if you did a whole bunch of transactions. So here's all of my debit accounts in this column, all my asset accounts, all my liabilities, and then my 4 different capital accounts. So if I wanted to check that the accounting equation is in balance, I could find the balance in each of these. So cash had a whole bunch of transactions here, but right now all I'm really interested in is the ending balance in that account. So I could add up the ending balance in all of these accounts and all of these and all of the assets and all of the expenses to find out if my accounting equation works. And that'll work, right? It's a little bit cumbersome to see it this way though. So the way that we generally look at it is a trial balance. And what I'm going to do is just pull the ending balance from each of these accounts. So I would do this from the ledger or from the T account. But once I've calculated what the balance in each account is, I just pull one number from each account, just that ending balance. Some of them are debit balances and some of them are credit balances. So a trial balance looks like this. And so I put, and you can see it goes in the same order. I put assets first, then liabilities, then capital withdrawals, then revenue, then expenses. And so this is what it looks like. So here is all my assets. They all have debit balances. Here's all my liabilities. They all have credit balances. My capital has a credit balance. My withdrawals have a debit balance. Revenue has a credit balance. And then all of my expenses have debit balances. Now, when you're putting it into my accounting lab, it'll let you get the order wrong and it still counts it right. But I think it's a good idea to get in the habit of putting them in order, because it's a lot easier to find if there's a problem. If you have them scattered all over, it's much, much harder to find if you miss something or if you have somebody in the wrong place or something like that. So get in the habit of putting all your assets together, then your liabilities, capital withdrawal, revenue, expenses. And it just makes it easier to find things. And then I add up my total debits and I add up my total credits, and they should equal. If they don't equal, the first thing I would do is add up the columns again, because a lot of times the error is just that you added wrong. If that still doesn't do it, make sure each account is in the right place. Make sure you don't have an asset on the credit side or a liability on the debit side. That's also a very, very common error, and that's where it makes it easier to find that if they're in order. So, or if you just missed an account. Sometimes you're copying over a whole bunch of T accounts and you just miss somebody. Again, if they're in order, it's much easier to find that error. So here's one where we're going to do it. So we'll put our account name here. I have it squished up a little bit. And then some of them will have debit balance and some of them will have credit balance. So we'll take our assets first. So we have cash, we have accounts receivable, and we have equipment being our assets. And assets all have debit balances. So I'll put cash, I'll take that balance, and I know that since it's an asset, that is a debit balance. So there's cash. Accounts receivable, I'm going to abbreviate so I can squish this in here, has a $4,000 balance, and I know that's debit. And then I have equipment, which is $45,000. Again, that's on the debit side. Then I'll take my liabilities. So I'm looking for things with payable in the name. So there's accounts payable, there's salaries payable, and there's interest payable. So that should be all my liabilities, I think, and those will all have credit balances. So I'll put accounts payable has a balance of $1,500, but that'll be on the credit side. So that takes care of that one. Salaries payable, $15,000. Again, it's a liability, so it has a credit balance. And then interest payable, $7,500 on the credit side. So there's assets, liabilities. The next thing is capital, right? So you'd put Henderson capital. That's $25,000, and capital is always on the credit side. Then the withdrawals. So that'll be Henderson withdrawals, $12,900. That'll be on the debit side. The next is revenue, and I have a service revenue account. So service revenue has a credit balance, so I'll put that $38,000 balance on the credit side. And then I have 3 expenses left. So I have rent expense, I have salary expense, and I have utility expense. All the expenses always have debit balances, so that's $10,000 on the debit side, $1,800 for salaries, and $1,300 for utilities. Then I add them each up. So if I add up my debits, I get $87,000. If I add up my credits, I get $87,000. And my debits equal my credits, and everything is happy. And so you can create a trial balance at any time, because the ledger always keeps an updated balance, so you can generate one of these at any time and see what the balance in each of the accounts are. How much cash do I have? How much money do I owe? All these types of things. And so again, if they don't equal, the first thing I do is re-add my columns. The second thing I would do is make sure that I've got everybody in the right place, that my assets are in the debits and my expenses are debits and my liabilities are credits. And then the last thing, again, I would just make sure I got everybody. Now, I'm doing it on here, I can cross them off as I go. But if you've got a bunch of accounts, sometimes you just miss one, so that would be the other way to check it. And that's it. The last thing in the account, in the chapter, is just about the debt ratio. And it's just total liabilities divided by total assets gives the debt ratio. And it just tells you what percent of your assets are financed through debt. Financing through debt's not necessarily bad. If there's no debt at all, that means that business is probably not reinvesting in technology or replacing equipment. And if there's no debt at all or extremely low, that probably means the business is fairly stagnant. So you don't want it to get too low, but you also don't want to get too high because that becomes risky then. So the debt ratio is a very, very common measure that both investors and potential lenders like banks would look at. You come up with a number, 0.25, so you got 25%. Is that good or bad? It really depends on the industry. So again, it's one of those things where in order to be meaningful, we have to compare that ratio to something else, to our competitors, to us over time, something like that, for it to really mean something. But the calculation itself is fairly simple. So that's the last part of the chapter there, and that's it for chapter 2.